Welcome to Stocks in Translation. I'm your host, Jared Blickery, joined by the voice of the people, as always, Sydney Freed. Thank you for tuning in. Before we jump into the conversation, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, wherever you get the podcast. And today we are welcoming Tom Sosnoff, a man who has been at the entrepreneurial forefront of trading for decades, from institutional to retail. You might be trading with his Thinkorswim platform, which he sold to TD Ameritrade back in 2009. These days, he is the CEO of Tasty Live, which he also founded along with Tastytrade, and a veritable media mogul here. I know you do daily market commentary, which I've been watching, and you have some interesting ideas about the market. And let me just recap. Full disclosure, we're recording this on the last day of September, so the end of the third quarter. Stocks are up, but we didn't really get that contribution from NVIDIA or the chip stocks, and so the rally broadened. And what are you seeing in the markets right now?
I'm seeing a market that's, well, again, remember, I'm a little bit of a contrarian,
yes.
So you got to be careful with me when you ask questions.
That's fine.
But I'm seeing a market that maybe it's a little frothy.
Frothy.
Can you define frothy for our viewers?
Yes.
Frothy, to be fair, frothy just means that when you're a trader or an active participant in the markets, I think of frothy as you have more like velocity of risk to the downside than you do to the upside. That's all it means.
To be fair, I mean, this is the best year through September I think we've seen since '97 in the S&P 500, so it's an outlier. It's doing even better than last year, which was a great year. And last year we got that spurt to the end, which really propelled things. But we're getting ahead of ourselves, and we want to tell everybody what is going to go on in this episode. So our word of the day is liquidity. We're going to get to that definition in a second. This episode is brought to you by the number 95. That is the percentage of trading that has moved off the floors of the exchanges to electronic trading, and that's probably conservative. And Tom, we just got your big picture views on the market, so I want to get to liquidity here. We've defined this before on the show, and just as a refresher, liquidity refers to how easily an asset can be quickly converted into cash without significantly affecting its market price. And there are different orders based on liquidity. You have market orders, limit orders, but just how do you think about liquidity?
I think about liquidity two ways. I think about it as another word for efficiency, marketplace efficiency, and I think about it as, we would define it as tradable.
Okay.
So if something is liquid, it's tradable and it's efficient. And when you're a customer, like I am, like you are, everybody, participating in the markets, the most important thing is to trade in liquid markets. It's one of the great things about U.S. markets is they're generally liquid across the board, across the whole spectrum. But the few, let's call it the top 200 underlyings, are very liquid.
I'm interested to know then your approach to market. How do you select trades? If you're not a technician, what are you looking at before you get in?
If you're looking at price, you can. I mean, I'm a junkie, so
So you're immersed in the market. You got a feel.
Yeah. Only every day for the last 40 some odd years.
All right.
But I would say that the first thing is some people will look at things like it's subjective price extreme. So, for example, you think something is expensive or you think something's cheap, because there is no way of actually defining expensive or cheap. So it's subjective price extreme. And then I'm a little bit of a volatility freak. So we measure everything on liquidity and levels of volatility. Volatility in relation to itself. So the volatility, for example, on Amazon, on Intel, on NVIDIA, relative to itself, meaning that is it high
for that particular
underlying, right?
All right.
Sometimes when I think about the word volatility, I also think about the word risk. What does risk mean to you?
No, risk means opportunity. So so volatility is a fear gauge, right? Essentially, I mean, volatility indexes are
roughly,
fear gauges.
yes.
But volatility, the definition of volatility is expected move. So when volatility goes up, the expected move is greater. When volatility contracts, the expected move is less. And in reality, when volatility goes up, the risk is less, not more.
But when it goes down?
When volatility goes down, meaning when volatility contracts, the risk is greater. Because volatility is the only indicator, it's the only true math equation in finance. So in other words, price is not mean reverting, but volatility is mean reverting.
By definition, by the way it's constructed. All
exactly.
Right. Can you tell us about your history? You're kind of a serial entrepreneur here.
Yeah.
We talked about Thinkorswim as a platform. I happened to be using TradeStation back in early 2000s, and so that was mine. But it was
Sure.
I'm very familiar with it, and why did you get into this business in the first place? Was it about democratizing finance?
No.
What were you trying to
I didn't
give
even
to
know
traders?
what democratizing finance meant.
I think it's a relatively recent term invented by millennials.
I
or
need
maybe
a
Gen Z.
definition for this.
But
I didn't understand that term. I mean,
So why
I didn't
did
even
you
know what
get into it?
entrepreneurship was. I was a pit trader in Chicago in the S&P pit for about 20 years, from 1981 to 1999, 2000. And I basically traded one product my entire career. And I was a successful pit trader. Let's just leave it there.
Mm-hmm.
And I traded index products. And as we're getting closer to 2000, the market was starting to go, a lot more of it was going electronic. And I could sense that we were going to lose market share from standing there. We were dinosaurs. Pit traders were essentially dinosaurs. And so I had this idea to build Thinkorswim. And myself and my partner Scott Sheridan, we took all the money we had made in the last 15 or 20 years before that, and we rolled it into a crazy idea called Thinkorswim. And there was no such intent to democratize anything. What we thought was we had a certain level of know-how about options that hadn't been popularized, and we took that, basically, we built technology around it and took it to the street. And everybody told us we were crazy, and it actually worked. And so we built an amazing company.
So let me ask you, you've exited companies before, including Thinkorswim.
Mm-hmm.
How long do you expect to hold on to Tasty?
We sold Tasty.
Oh yeah, you sold it.
Tastytrade.
You sold Tastytrade.
But
Here's Tasty
you're still in
Live.
Tasty Live.
Oh yeah, it's the same thing.
Oh, okay,
Yeah.
so it's
one,
sold.
one is
Yeah.
We sold Thinkorswim in 2009. We were a publicly traded company, and we sold it to TD Ameritrade for $750 million. And then in 2021, we sold Tasty for $1.1 billion.
How do you make a decision to sell?
You get lots of buyers at the same time, and then you don't have a choice.
you blindly pick.
It's a great question, because as an entrepreneur, first of all, it's a high-class problem, okay? So let's not...
Good problem to have.
It's a good problem to have.
Yeah.
And most times, nobody ever wanted to touch us. Like, we were like the black sheep of the industry. And then all of a sudden, when people get excited about you because they come after you, whatever it is, somehow everybody knows about it. I don't know how the investment banking world works, but when we built Thinkorswim, we had 4 offers at the same time, and when we built Tasty, we had 5 at the same. But it took 10 years. So we built it in 1999, 2009. We got our first offer, and then there was 4 offers, and maybe 5. In Tasty, there was 5 offers, and that took 10 years too. We built it in 2011 and 2021.
I want to ask about retail trading.
Sure.
We've seen just a tremendous change just in the dynamics of it. And now we have more options, more zero-day options available. Just in general, how do you think the game has changed? And do you think it's affected the institutional side, or are things pretty much the way they were before the pandemic?
There has been some normalization in the industry, but to be fair, I really don't care about the institutional side. I'm an advocate for retail investing and for, self-direct investors, do-it-yourself investors. We don't even support institutional traders. We don't even take them on our platform. So we could care less. The industry itself has grown leaps and bounds because, one, we popularized, derivatives. And the cool thing about derivatives, it's just about capital efficiency. There is no difference between trading stocks, options, or futures. It's just about how much capital does it take to do this, virtually the same thing.
Yeah, and just for the viewers, derivatives can include stock options. They can include derivatives based on which are futures, contracts for different contracts. I guess they have in the UK.
Contracts for differences are not legal in the U.S.
But those that would be for our UK audience that would understand that.
Yep.
Just in general, how do you see the options for retail traders expanding maybe into the future? Do you think anything new is coming down the line?
Sure. I think you're going to see. We've had some really important transformational periods, like, obviously 2020, 2021. But I think you're going to see a broadening of underlyings that you can trade. Like, I think you're going to see everything from event-based obviously politics, but eventually sports. I think you're going to see tokenization. We're going to digitize everything. It's just a matter of time. And we're going to tokenize everything, so you'll be able to trade virtually any product in a single currency anywhere in the world and clear it centrally. So doesn't have to necessarily be cleared. It might not even have to be cleared on a blockchain. So I think all that stuff.
That's really fascinating. Do there need to be a lot of legal and regulatory changes? Do we need changes in state betting laws, or do we have the framework necessary to implement that?
Sports possibly need changes in state betting laws, but nothing else. And I think that what you're seeing now is that in the world of options, we call rate of change gamma. And the rate of change in just everything in the world now is lightning fast compared to the way it was
And
10
probably
or 20
going
years
up.
ago. And probably going up. So what used to take maybe 5 or 10 years to organically change is now changing almost instantly. So, the thought of, could we really get to tokenization in some way? And the answer is, 10 years ago I would have said it would take in 20 years. Now I'm thinking, it can happen in 3 months.
Are there risks in that moving so fast now?
There's no risk, because the only risk is not doing it because somebody else will do it. Like in the US, we control this massive pool of liquidity, which is why the whole world trades here. And it's why, it's why we're here doing this. It's why we have so much stuff to talk about. It's why you have all these different stocks.
We have a lot to talk about.
Yeah, I mean, we have, it's why our marketplace is, bigger than the rest of the world multiple times over. And we don't want to fall behind. We don't want to be disrupted by somebody else, even though nobody's close. And so the answer is, I think it happens fast. I think it happens here.
Let's leave it there. Want to bring that up in a minute, but we need to take a short break. Coming up, we're going to talk about the great migration in trading off of the floor to server racks, plus who wore it better that will get your active versus passive juices going. And we are back. This episode brought to you by the number 95, which is the percentage of trading that is now conducted online. And there are pros and cons, as with anything. So a big pro is speed. For some, a big con is speed. But also, you don't have a human pilot with with electronic trading. That's something that I hear on the floor sometimes from some of the old school traders there. Do we need any of the remnants from the old system, or have we just demonstrated since the pandemic that we can be fully electronic now?
Oh, we don't need any of the old remnants unless you need somebody to go grab lunch for you. I mean, we do not need to go backwards one bit. There is no risk in speed. There is no risk in fully. We don't need what we had before. If you're thinking about negotiated orders and stuff like that, again, our concern should not be, worrying about some institution getting a penny worse on their fill. Our concern should be, a retail investor getting, down to the tenths of pennies, and we're there. And so I think that, no, faster, bigger, stronger, it's all great for the customer.
What about the flash crash? Is that just because the system has not been implemented as well as it could have been? We've seen these throughout the market in various forms over the years, not only in indices, but individual stocks. So is that just because we did a bad job of implementing things?
Remember, you're talking 2010.
Yes.
Okay.
But we're still seeing some remnants of that.
The flash crash was 2010, and the technology in 2010 could not support the amount of data that we can support today.
So it's not a comparison.
There's no comparison.
Okay.
And now, are there going to be times when legacy systems fail? Yeah, and it's really incumbent upon retail brokerage firms and institutional firms to build better technology. It's inexcusable today that the money that they spend, more money on marketing, they spend on building technology. And so, our philosophy is very different. That's why we don't have any issues when there's a tech problem at most other firms. But I really think that it's inexcusable now, and that firms should be able to handle whatever the market brings to you.
Are there any downsides to high frequency trading?
No, best thing that ever happened for customers. You got to remember that high frequency trading has transformed the entire industry. And we're not a high frequency firm. We have a high frequency. We use high frequency middleware for retail customers so they can route on really fast systems, but we're not a market maker. So we just fill them and bill them. We just send to different high frequency firms our order flow. Exchanges are not competitive with high frequency firms. So as much as people want to hate, the Citadels and Susquehannas and the Wolverines and the IMCs of the world, the reality is the exchanges can't compete. And so the reason Citadel gets the order flow is not because they pay for it, it's because they're better. And our customers get better fills, and they get faster fills, and they're also accountable for what they do. So high frequency trading has actually been what's blown up this industry as far as its ability to just facilitate so much business.
What would you say to people who say, retail traders who say, well, I'm getting front run in my orders. I put an order in.
Ridiculous.
Ridiculous?
Not even. A retail customer on our platform fills an order in, 20, just about 20 plus milliseconds. I mean, I don't know what they're getting front run on.
What's front run?
Well, that's good. So you
Yeah.
you put an order in, and somebody steps in front of you, and they run with your order in front of
No,
you.
it doesn't happen.
Okay.
I mean, the average size of our orders are three and a half or 4 contracts, or 200 shares of stock or 1 future. There's nothing to step in front of. No high frequency firm is. They facilitate millions of orders a day, literally millions of orders. There is no human interaction. It's all electronic.
In the movie Dumb Money, did you see it?
Yeah.
Okay. There are some inferences in there. Some behind-the-scenes
Yeah.
stuff might have happened between Citadel Securities
Yeah.
and Melvin Capital Management. Do you think there's any merit to any of that?
No.
Does it even matter?
No, and I'm not a spokesperson from Citadel either. They're a trading partner of ours, but I've had my good stuff and bad stuff with Ken and everybody else. I think, they're amazing at what they do, but I think that was a movie, they had to have a little fun with it. And plus, remember, the whole meme stock thing was a crazy couple of days.
Yes.
It was insane.
I couldn't believe it while it was
No,
happening.
I couldn't either. So I think that a lot of people were shocked, including Citadel, including Robinhood, including, Melvin Capital. I mean, it was a weird couple of days.
It was. We want to get to our final segment of the day, Who Wore It Better? And we are setting up an old rivalry that we've tackled before. And today we're doing it with a twist. So this is active versus passive investing. On one side, we have active investing, hands-on, risk-defined, hopefully with a plan, but executed by a human with discretionary input. And on the other, we have set it and forget it, passive investing. So easy that Ron Popeil himself maybe might have a plug or two for it. But Tom, we want your opinion today.
Oh my God, don't even go there with me.
I know
the
you're
answer
going to go
get.
someplace interesting.
Yeah.
So active or passive? I know you're in the active.
I'm a spokesperson for the active trader. I mean, I'm the poster child.
But is there anything wrong with passive?
There's nothing wrong with passive investing at all. There's nothing wrong with it on the surface. The problem with passive investing is that when you start passive investing when you're young, let's say you're in your 20s or 30s, whatever it is, and then you close your eyes, you take a nap, you wake up, you're 55 or 60, and then you go,
and you haven't made any
where the hell did
decisions.
my life go? And I don't even know what these markets do or how they work. The whole concept of active trading is you learn how to make decisions, you learn how to take risk, you learn how to assess probabilities, you learn how to invest strategically if you want to, and then if you don't want to, you can always go back and passively invest. But you don't learn how to take risk as a passive investor, and I think that's the biggest. If you're going to go somewhere in life, you have to learn to take risk.
But then you also have to have some sort of financial literacy, be self-taught about the markets. Not everybody is taught these things in school. So what's kind of your take on financial literacy?
Well, the beautiful thing is, so I am not a financial literacy person either, because I don't believe.
Wait, what do you mean you're not a financial literacy person?
What?
I'll
He's
tell
gonna
you,
tell us.
because I don't believe in investor education. I believe that markets, like I said before, are efficient. Therefore, somebody that's been doing this their whole life, like me, and somebody that may have never even participated in the markets before ever, we are exactly equal when it comes to deciding what's going to happen in XYZ stock tonight, tomorrow, next week, or next month. There's absolutely no difference between the two of us. You could think I know a lot, but the reality is I don't know what's going to happen next. So the concept of doing is essentially financial literacy. By an old school definition.
What about money management, though, risk management? You might be on equal footing saying, okay, the S&P 500 is going to do this tomorrow, and somebody else has a different guess. But you have decades of experience with money management. You know how to keep yourself from blowing up, and not everybody has that skill.
I'm going to teach you how to keep yourself from blowing up in 1 second. You stay small.
Stay small.
The whole key to you cannot. Risk is one of the most overblown topics in all finance. Risk is something you can't control. It's almost like you can't control another car if it hits you type of thing. There's certain things you can control. And in life, control what you can control and don't worry about the stuff you can't control. So the only thing you can control in finance is actually what you do. And if you keep your size small, which means a lot of different things to different people, but if you keep your size small and you diversify, meaning you don't put too much money into any single one underlying because you don't know what that's going to do, you've essentially defended your position. You've defined your risk. And that is the definition of risk. And anybody can do it.
And then you learn along the way.
And then you learn along the
So
way.
you're essentially saying learn by doing. Don't learn like online. Just learn by physically doing it.
You can learn any way that you get engaged, like any way that you're able to engage in decision making. I don't care if you go to some site and you buy or sell trading cards. Like I don't care what you do, but anytime you make decisions, it changes the way your whole perspective on risk. So even if you went to a gambling site, it doesn't matter to me. Of course, the financial markets are far more efficient because instead of a 10% give up, there's a fraction of a penny. So anywhere you go to make decisions that involve risk, whether it's emotional, whether it's monetary, whatever it is, that's how you get better at taking risk.
Do you think that brokers a lot of times just kind of pass? Well, I know. So I come from a regulatory background, and so I know that you got to check certain things off if you're a broker, and one of those happens to be investor education. And a lot of times, I think it just seems like a substitute for actually helping their customers or providing better services. Is that whatever they paste on their website in terms of investor education is meant to be a substitute for that, but it's just a poor one. You have any thoughts on
The whole concept of suitability, I think you're going down the suitability route there.
Perhaps.
Yeah, I think the whole concept of suitability is a misunderstood one. I think it's a legacy concept, and it's been around for.
So you have accredited investors and then
accredited investors, that only matters with non-exchange, with stuff that's off an exchange.
Private offerings.
Yeah, private offerings and stuff like that. In the world of online trading, there's no such thing as an accredited investor. But there are people, like with us, we don't care how much money you have. So whether you have $2,000 or you have $2 million or $20 million, you can all do the same stuff. And we don't care what kind of account you have, whether it's an IRA account or a regular margin account, whatever it is. So we try to break down those barriers. And I think it's long overdue. It's almost like, we don't want to tell people what they can and can't do. So I think that whole suitability thing, it's going away. And it should have gone away a long time ago.
Interesting.
You are a self-identified contrarian. I want to get right now your biggest contrarian take in the markets.
Biggest contrarian take. Well, I probably wouldn't buy AI stocks here.
Why?
And it looks like they're coming back a little bit. NVIDIA close to records.
I know, and they're up. I don't like things. I don't like things that I think are
Frothy.
a little frothy. Yes.
Okay.
I mean, my biggest contrarian take, I guess, right now. I was just looking at the markets, just think about what's super rich out there right now. I would say probably, if you wanted to pick a specific thing, I would say probably gold, and all the precious metals seem rich to me. Gold, silver, copper, those kind of things. But also some of the AI stocks seem really rich to me.
I think we got time for one more.
Yeah, you have an
Under a
event.
minute.
You have an event coming up, and you're also traveling. You do a lot of you give a lot of speeches. I think building a complex portfolio, an active trader's path to success.
October.
Tell us a little bit. It's coming up in October 19th, LA.
Well, this is we've done 8 of those this year,
Oh,
all around
wow.
the country. So
Yeah.
that's
Well, tell us
series.
a little bit about the series.
Oh, that series? Yeah, the next one's in LA, and then there's one more in Dallas after that. But we did New York, was our first stop this year. This has 6 speakers, and what we do is we build a portfolio. It's about 2 hours and 45 minutes long, and we start with building all the little aspects of a portfolio and then tie it together at the end with an active trading portfolio that we just we synthetically put together a portfolio that includes stock options, futures options, pairs trades, digital assets, cash, everything. So we build just a sample portfolio, but we have 6 different speakers, 2 women, 4 men, and everybody covers different stuff. Like some people cover futures options, other people cover options, stocks, everything.
All right, everyone check it out. We have run out of time. Surprisingly, it happens every episode. Make sure to like us on all your favorite podcast platforms. We got to check out, keep your dial tuned to Yahoo Finance.